In this lesson, using Elliott waves to trade, the learning objectives are: you should know how to trade using Elliott waves, and you should know the risk of trading Elliott waves. In order to get an overview of the market, you can use Elliott wave analysis. This is probably one of the most complex tools in technical analysis, so it can be difficult to understand initially, but once you master the technique, the benefits will far outweigh the risks. The patterns identified by Elliott waves occur across multiple time frames. That means that a completed 5-wave sequence on a small time frame, like let's say a 15-minute chart, may represent just the first wave of a larger sequence unfolding on a 1-hour chart, and so forth. In a macro sense, each unfolding wave pattern is part of the bigger wave pattern unfolded in the higher chart. Many traders combine Elliott waves with Fibonacci ratios in order to measure the potential of each price move by finding the location of high probability turning points. The key points you should understand are: the potential impulse or corrective levels are usually measured by percentages of the previous wavelength. Wave 3 in a 5-wave sequence is influenced by wave 1 and usually shows a ratio of 161.8% of wave 1. The other two impulse waves are usually of minor length and equal to each other. Another point is a corrective move that follows an impulse move from a significant low or high usually retraces 50 to 61.8% of the preceding impulse. Wave 4 usually corrects as far as 38.2% of wave 3. Wave 2 most of the time doesn't overlap the start of wave 1. The start of wave 1 is an ideal level to place stop losses. For corrective waves, wave A of the correction reaches 161.8% of the size of wave 5. Wave B is a minor correction and it retraces 50% of wave A, and wave C usually shows a ratio of 161.8% of wave B. The most important mistake to avoid is relying on Elliott waves as a standalone analysis tool. Always apply it as a supportive measurement. For example, you can use it in addition to the RSI indicator. Another thing to avoid is jumping into a trade at a very early stage. You should always wait for confirmation that the trend is actually going to shape the necessary formation, otherwise you risk trading a false signal. Make sure to avoid the application of the theory with real money right from the start. Always do your homework by looking at the charts and applying the theory in a demo account. Make sure to plot the waves sequence in both scenarios, a descending and ascending market. If at any point the waves break one of the rules I've stated, then this indicates that the pattern is broken and you should avoid trading on it. In conclusion, Elliott wave theory provides a complete framework to understand market behavior. Combining the Elliott wave theory with Fibonacci ratios help traders to take decisions as it provides entry and exit points. The main flaw of the Elliott wave theory is its high degree of subjectivity. Another flaw is that for traders, the Elliott wave theory is among the hardest tools to use. Although it is easy to learn on paper, when it comes to real trading, many individuals give up somewhere along the way as they struggle to implement their theoretical knowledge in real life.